Urban Affairs. Today, we'll vote on the nomination of Ron Borzakowski to be Director of the Office of Financial Research at Treasury. If confirmed, he would oversee an office responsible for identifying and guarding against risks that reach across the financial system, an important position and one we need to fill quickly. He's qualified. This committee previously advanced his nomination. Given we have strict time constraints, I'll forego offering a longer opening. Senator Scott, do you wish to offer an opening?
No.
Okay, thank you. We'll proceed to a roll call vote on the nomination of Ron Borzakowski to the Director of the Office of Financial Research at the Department of Treasury. The clerk will call the roll. Nomination of Ron Borzakowski be Director. Clerk will call the roll.
Mr. Chairman.
Aye.
Mr. Reed.
Aye.
Mr. Menendez. Mr. Tester. Mr. Warner. Ms. Warren. Mr. Van Hollen.
Senator Van Hollen's name was
Aye.
called. Thank you.
Ms. Cortez Masto.
That's pretty good.
Ms. Smith. Mr. Warnock. Mr. Fetterman. Ms. Butler. Mr. Scott.
No.
Mr. Crapo.
No by proxy.
Mr. Rounds.
No by proxy.
Mr. Tillis. Mr. Kennedy. Mr. Haggerty.
No by proxy.
Ms. Lummis.
No.
Mr. Vance.
No by proxy.
Mrs. Britt.
No by proxy.
Mr. Kramer. Mr. Daines.
No by proxy.
Mr. Chairman, the vote is 12 in favor and 11 opposed.
Thank you. With that, the ayes have it. With that, the nomination is hereby reported favorably to the full Senate. Thank you, everyone. The clerk will see to reporting Dr. Borzakowski's nomination to the full Senate. Any other senators wish to make a statement before the hearing with Dr. Powell? With Chairman Powell. Okay. The executive session is now concluded. Thank you for all arriving on time so we can move forward. We'll take a 90-second, 120-second break until Chair Powell arrives, which he has, and get seated, and we'll begin that hearing. What do you say?
He said all you're going to do is talk about your gubernatorial candidate between.
Housing and Urban Affairs. Today, we'll vote on the nomination of Ron Borzakowski to be Director of the Office of Financial Research at Treasury. If confirmed, he would oversee an office responsible for identifying and guarding against risks that reach across the financial system, an important position and one we need to fill quickly. He's qualified. This committee previously advanced his nomination. Given we have strict time constraints, I'll forego offering a longer opening. Senator Scott, do you wish to offer an opening?
No.
Okay, thank you. We'll proceed to a roll call vote on the nomination of Ron Borzakowski to the Director of the Office of Financial Research at the Department of Treasury. The clerk will call the roll. Nomination of Ron Borzakowski be Director. Clerk will call the roll.
Mr. Chairman.
Aye.
Mr. Reed.
Aye.
Mr. Menendez. Mr. Tester. Mr. Warner. Ms. Warren, Mr. Van Hollen,
Senator Van Hollen's name was
Aye.
called. Thank you.
Ms. Cortez Masto,
That's pretty good.
Ms. Smith, Mr. Warnock, Mr.
Chairman Powell, if you'd like to, after your opening statement, give it again, you can certainly do that. The Fed has immense power in shaping our economy. Your job is clear: promote stable prices and maximum employment. Today, the cost of living is still far too expensive for most Americans. The Fed has only one tool available to fight those high prices: interest rates. That tool does nothing to address the real costs, the real cause for why costs remain too high. Corporations price gouging to boost profits and make their shareholders richer. Higher interest rates don't force corporations to lower their prices, but high interest rates are raising housing costs, hindering wage growth, stifling small businesses. We all know that. Now's the time for the Fed to decide if it's going to make good on its commitments to workers and to their families by lowering interest rates, by protecting our financial system from Wall Street executives who have used their wealth and their power to influence economic policy and avoid accountability for their for their risky bets. Keeping rates too high for too long strangles the economy. No one wants this. It makes it harder for small businesses to expand and hire more workers, undermining job creation. Higher rates also stifle overdue investments that are creating high quality, good paying jobs and that are necessary for us to remain the most competitive and innovative economy in the world. High interest rates are raising housing costs higher and higher for families already facing a tough market with too few options and too high prices. I hear from so many Ohioans who feel trapped. Those who rent feel like they'll never be able to afford to buy. Those who already own their homes feel like they'll never be able to afford a larger one if they decide to grow their family. If they're fortunate enough to have an interest rate from a couple years ago, they obviously don't want to give it up. It limits their choices, it limits the housing supply, and by driving up construction costs, higher rates make it even harder to build new apartments and homes. So we have even less supply at exactly the same time when it's harder to afford a mortgage. Families are stuck delaying the purchase of their first home and renting for longer. That cycle drives rents up even further. Americans pay a steep price for higher interest rates. Continued high rates are not going to make life less expensive for workers and their families. We know why prices are high years after supply chains have improved. It's the same cause of so many of the problems in our economy. Corporations want bigger profits to reward their executives. Today we'll vote in 2022, at the peak of inflation, corporate profits soared to historic levels. That's not hyperbole. That's fact. Corporate profits soared to historic levels. As you know, where those profits went, right into the pockets of their top executives. That same year, the largest multinational corporations gave out nearly $1.5 trillion in stock buybacks and dividends. Americans today pay more for groceries than they have in 30 years. Ohioans are paid for corporate. Every time you go to a grocery store, Ohioans pay for corporate executives bonuses and stock buybacks. Every time you go to the grocery store, grocery shoppers are paying for corporate executive bonuses and stock buybacks. The biggest corporations are always finding new ways to charge people more to increase their profits. Fast food restaurants, big stores are experimenting with electronic price tags so they can change prices constantly, making it easier to sneak prices up little by little, making it harder for people to comparison shop and find the store at the lowest price. Many companies increase their profits by charging more for less. The media started calling it shrinkflation. Senator Casey, our colleague from Pennsylvania, has particularly been a leader pointing this out. A bottle of Gatorade used to be 32 ounces. Now it's 28 ounces. But the price hasn't gone down. And if anything, it's gone up a bit. It's why I introduced legislation that would stop that kind of deceptive corporate practice. It's the kind of solution we need to take on corporate price gouging. Has nothing to do, Mr. Chairman, as you know, with higher interest rates. The Fed doesn't only set monetary policy. You also make the rules that keep our banking system safe and sound and consumers' money safe. We've had some positive development, Mr. Chair, since the last time you testified in June, like the update to the Community Reinvestment Act. Thank you for your work on this. This took years of listening carefully to all stakeholders. It was long overdue. We'll be watching to make sure you implement this quickly so banks are fulfilling the purpose of the Community Reinvestment Act. I spoke to Ohio bankers yesterday, most of them small banks. They understand the importance of this. You also issued an updated capital requirements proposal called Basel III, the subject of much discussion in this committee. Strong capital requirements, how we ensure if Wall Street bets don't pay off, shareholders and investors are on the hook, not taxpayers. Too many examples in this committee, in this Congress, in this country of taxpayers holding the bag for corporate misfeasance and malfeasance and greed. We need these guardrails in place. I urge you to remain committed to protecting the public despite the massive amount of money big banks and their lobbyists are spending to trying to kill these taxpayer protections. Let's finish the job. Let's finalize Basel III. Last year's bank failures also demonstrate the dangers of letting the banks chip away at rules and oversight. It's entirely predictable. Bankers desperate to increase their already massive profits take big risks that undermine our economy. When things go wrong, bank executives come to regulators with their hands out, accepting no responsibility. It's why Congress must finish the job and pass our bipartisan Recoup Act. Senator Scott and I worked on 21-2 in this committee to hold senior bank executives accountable when they gamble with customers' money. When the biggest banks exercise special privilege, they do so at the peril of our broader economy. We've seen that too many times. We know that's the source of so much that's wrong in this country. Big corporations using their power and influence to write the rules of our economy to the benefit of them and their executives and their investors, to the detriment of everyone else. It's why I stand up for workers and why I stand up for their right to organize. It's why I stand up to take on railroads and drug companies and the biggest banks and corporations who time and time again try to rewrite the rules to increase their profit margins. Chair Powell, I look forward to hearing from you today. Thank you, how the Fed will work to promote an economy where everyone who wants a good job has the opportunity to find one. Senator Scott.
Thank you. Chair Powell, thank you for coming this morning. Good morning. Appreciate you being here. Certainly 3 days, March 10th, it will be the 1-year anniversary of the failure of the Silicon Valley Bank. SVB marked the third largest bank failure in U.S. history and certainly the largest since the 2007-2008 financial crisis. I've said it many times before, and I'll say it again today, that there are 3 major components to SVB's failure. First, the bank was rife with mismanagement. Second, there was a clear supervisory failure, and our regulators were certainly asleep at the wheel. And third, President Biden's reckless spending caused record high inflation, which resulted in drastic interest rate hikes and tremendous loss. When you print and spend trillions of dollars at the end of COVID, we should not be surprised that we have record high inflation. Record high inflation translates into today still 40% higher for gas for your car, 30% higher for your food, 20% higher for your energy costs. The devastation the average American is facing because of Bidenomics is undeniable, but certainly measurable. So I'm glad to spend some time talking about the state of our economy, an economy that has been ravaged, as I've just spoken about, by inflation, suffering under the weight of an open border and millions of illegal immigrants, and drowning in disastrous regulations. I hear from my constituents all the time that inflation and an unsustainable cost of living continue to impact their families. For far too many, the American dream seems further and further out of reach than ever before. And frankly, the past 3 years of this administration's failed policies have landed us right in that spot. In fact, last month, Treasury Secretary Yellen sat before this committee and attempted to spin a narrative of how strong the economy is, how well off consumers are, and how much people have in the bank, thanks to Bidenomics. But in the midst of this, she also admitted that many prices are not going down. In fact, she said, and I quote, "We don't have to get these prices down." Tell that to the mechanic working in South Carolina.
Trying to kill
Tell
these
that to
taxpayers.
the teacher trying to put gas in the tank. It is simply unacceptable. Because the truth is that Americans are now spending more of their income on food than they have in 30 years. The truth is that housing affordability remains at its lowest level in 40 years. But inflation isn't the only concern I'd like to raise. I'd also like to address the economic impacts of illegal immigration. During your recent interview on 60 Minutes, you stated that over time, the U.S. economy has benefited from immigration. Let's be clear. America is a nation of immigrants, no doubt. But when we talk about illegal immigration today, we must also face the dire reality that our towns and our cities are suffering from the adverse impacts of illegal immigration facilitated by the Biden administration's open, unsecure, and unsafe southern border. Because of President Biden's policies, we've seen over 7 million illegal immigrants cross our borders in just 3 years. By the time this election happens this year in November, the numbers suggest it could be as high as 10 million illegal immigrants coming into our country. So we cannot have an honest conversation about the benefits of legal immigration in our labor force without also addressing the elephant in the room. Our country is strained. Our economy is strained under the weight of illegal immigration. In fact, recent reporting has highlighted that cities and states across our country are struggling to keep pace, and some have been forced to cut public services to Americans in order to fund the cost of feeding and housing illegal immigrants. One clear example we saw in New York City were the poorest kids in the city, minority kids in the city, were stuck at home because the city was using the schools to house illegal immigrants. Another example, the city of Denver recently announced that some of its employees may have their hours cut in order to reallocate funds toward the city's migrant crisis. How in the world is that fair to Americans? It's not. We must get the illegal immigration crisis under control, because if we don't, our local economies will continue to be crushed and opportunities will continue to be stripped from our citizens and their families. Finally, as if inflation and the negative impacts of illegal immigration were not enough, the tsunami of regulatory red tape coming from our financial regulators further threaten economic opportunity across the board. For months, we've heard bipartisan criticism of the Fed's Basel III endgame proposal, which will restrict lending and access to credit for those who need it the most. I was certainly pleasantly surprised to hear your comments about Basel III and your thoughts on its future. When 97% of the comments that you receive are negative, that's good news. Good news for the American consumer, good news for entrepreneurs who would like to start a business but do not have access to capital, perhaps even good news for millennials who would love to become a first-time home buyer. The opposition to Basel III comes from diverse array of interests, from community leaders, farmers, to housing groups. We've even heard opposition in this very room, on this very committee, from Democratic senators. I look forward to hearing your testimony and looking forward to asking some questions as well.
Thank you, Senator Scott. We'll hear today, as we do every 6 months at least, from Chair of the Federal Reserve, Jerome Powell, on monetary policy, the state of our economy. Please proceed. Thank you for your service to our country.
Thank you, Chairman Brown, Ranking Member Scott, and other members of the committee. I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report today. The Federal Reserve remains squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward these objectives over the past year. While inflation remains above the FOMC's objective of 2%, it has eased substantially, and the slowing in inflation has occurred without a significant increase in unemployment. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals have been moving into better balance. Even so, the committee remains highly attentive to inflation risks and is acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. The FOMC is strongly committed to returning inflation to its 2% objective. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. I'll review the current economic situation before turning to monetary policy. Economic activity expanded at a strong pace over the past year. For 2023 as a whole, gross domestic product increased 3.1%, bolstered by solid consumer demand and improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains relatively tight, but supply and demand conditions have continued to come into better balance. Since the middle of last year, payroll job gains have averaged 239,000 jobs per month, and the unemployment rate has remained near historical lows at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers, particularly among individuals aged 25 to 54, and a continued strong pace of immigration. Job vacancies have declined, and nominal wage growth has been easing. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. The strong labor market over the past 2 years has also helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased notably over the past year, but remains above the FOMC's longer-run goal of 2%. Total personal consumption expenditures prices, or PCE prices, rose 2.4% over the 12 months ending in January. Excluding the volatile food and energy categories, core PCE prices rose 2.8%, a notable slowing from 2022 that was widespread across both goods and services prices. Longer-term inflation expectations appear to have remained well anchored, as reflected by a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. After significantly tightening the stance of monetary policy since early 2022, the FOMC has maintained the target range for the federal funds rate at 5.25% to 5.5% since its meeting last July. We have also continued to shrink our balance sheet at a brisk pace and in a predictable manner. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. We believe that our policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economic outlook is uncertain, and ongoing progress toward our 2% inflation objective is not assured. Reducing policy restraint too soon or too much could result in a reversal of progress that we've seen in inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the policy rate, we will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target rate until it has gained greater confidence that inflation is moving sustainably toward 2%. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Thank you, Mr. Chairman. You've acknowledged the Fed likely waited too long to raise rates when prices shot up in 2021. We can't make that mistake again, Mr. Chair, at the expense of workers. If the Fed waits until unemployment starts increasing, it may be too late to cut rates in time to save American jobs. Why shouldn't the Fed act now to prevent workers from losing their jobs rather than reacting after the fact?
So we're well aware of that risk, of course, and very conscious of avoiding it. And what we said is if what we expect and what we're seeing is continued strong growth, a strong labor market, and continuing progress in bringing inflation down, if that happens, if the economy evolves over that path, then we do think that the process of carefully removing the restrictive stance of policy can and will begin over the course of this year.
I mean, I know we've had this conversation publicly here or privately also that, working people are hit the hardest with inflation. They're also hit the hardest when companies try to cut costs with layoffs. This town too often seems to forget that maximum employment is part of the Fed's dual mandate. Let me ask you about bank supervision. Senator Scott mentioned that. Last year's bank failures illustrate the need for strong oversight. SVB grew too big, too fast. Fed supervision didn't react decisively enough. The Fed, in response, undertook an assessment of its supervisory process to identify and address gaps related to the speed, the force, the agility, if that's the right word, of its supervision. Explain what concrete steps the Federal Reserve's taken to strengthen supervision and any specific areas where work to make improvements is ongoing.
So this is a very broad area of work. There are, many people in the Federal Reserve System who are involved in supervision, thousands of them, and there's a rule book, and so there's been careful study and thought and a lot of listening to understand how we can meet those goals of being quicker and more effective. Basically, is how I would say it. If you look at Silicon Valley Bank, we weren't quick enough and we weren't effective enough where we were in, and so we're working hard to develop a new rule book and another set of practices, which is still going to be evidence-based and fair, but it's going to involve earlier interventions and more effective ones. And I think this is work that's ongoing and will be for some time.
Thank you. The job of the Fed, of all public officials, is to serve the American people, not their stock portfolios. We've seen abuses in this body. We've seen abuses at the Federal Reserve. I wrote to you last month asking the Fed to identify substantive penalties for board officials who violate the trading rules. Where is that in the process? And I expect these rules in place before the next monetary policy hearing in 6 months. Where is it?
We got our own Inspector General gave us 6 things to work on. I read the list from beginning to end, and the 6th one was what you said, and I just said we're going to do all of these. Let's get going. So we've done 5 of them, and we're working on the 6th.
And it will be finished within 6 months when you're back?
I want to get it right. I certainly hope so and expect so.
Expect so is a better answer than hope so. One last question. More and more, many companies use algorithms that combine competitors' price information to engage in what they call dynamic pricing or surge pricing. You know that corporate PR teams worked hard on this. Just another way for corporations to make it harder for consumers to seek out lower prices and to pad corporate profits. Are you concerned that the wide adoption of these price gouging strategies, these pricing schemes, if you will contribute to inflation?
I think it works both ways. Let me say that we're well aware of this trend and we're monitoring it. Remember that prices go down when there's no one in the store, and they go up when there are a lot of people. If you're doing dynamic pricing, same thing with the ride companies. It works both ways. I don't know that it have implication for inflation. It would certainly have implications for consumers who need to be informed.
You think that this kind of surge pricing might lower prices overall?
That's my understanding is that the idea is that in slow periods, prices actually go down, and in busy periods they go up.
But these are sophisticated economists working for these big companies, and they're not going to do things to lower their profits.
I think the price mechanism is incredibly important in our economy. I think we need to give companies the freedom to do that as long as they're not fixing prices or failing to disclose the nature of the price changes to the public.
I have a few seconds. Research has indicated constrained supply was behind a significant amount of the inflation we've seen over the last few years. If the supply chain, for instance, of autos had been more resilient, or if there had been more housing availability, would that have made your job easier?
Yes, in a word. Yeah, a big part of the inflation was, and we saw it in 2023 when the supply chain problems unwound and when the labor supply shock that we had unwound as well. We saw inflation come down very quickly in the second half of the year. But it's also down to tight monetary policies playing a role as well.
Which leads me to the plea with you to speak out about inflation, about the contribution of corporate profits and greed to inflation. Thank you.
Oh, I know you are done. That's true. Well, I was
Find yourself agreeing with me more and more often? Is that what?
that would be a nightmare, and I'm awake. So what I would say, however, is that the fact of the matter is that so often, if in fact 60%, I actually listened to what you said, which was remarkable. The fact that 60% of Americans today can't afford a $1,000 emergency, I can't imagine how the average millennial affords a down payment for a home. I can't imagine how they take into consideration when they're looking at a snapshot of their financial future, fixing and repairing or having a plan for obsolescence that happens for every homeowner in the country. I think the issue is far more complicated and would love to delve into that over the next 4 minutes and 18 seconds. But my first question is a combination between the challenges of illegal immigration and crime. It seems like every single week there's another story of another city underwater attempting to feed and house millions of illegal immigrants, and American taxpayers are footing that bill. Like I mentioned in my opening statement, just recently in Denver, we saw city workers having their hours essentially zeroed out so that the city could allocate more resources for the illegal immigrants. In San Francisco, they say that the average cost between San Francisco and Oakland, because of crime, is almost $4 billion. Couple that with in New York, you see Governor Hochul bringing out the National Guard and the state police to help reduce the impact of crime. At the same time, Mayor Adams says he needs more money because the state of affairs from illegal immigrants in the city is devastating the economy, scaring the citizens, and reducing the opportunity for business as usual to return to New York City. So my question is, can you explain how our economy is expected to continue shouldering the burden and the costs because of illegal immigration? And what, if any, information do you have as it relates to the impact of this surge of crime in our major cities on the economic outcomes of those cities? Because I heard the discussion that when you have more folks in the store, you have more shoppers, except for these days, when you have more folks in the store, sometimes they're just there to steal.
So you quoted my statement earlier, and it was an accurate quote, for which I thank you. But I would say right before that, what I said was immigration policy, very important, very much under discussion, and it's none of our business. We don't set immigration policy, and we don't comment on it. So,
but you commented on immigration. So my point, though, is that when you're going to tell a story, please tell the whole story, especially when the nation is frustrated by nearly 10 million folks by the end of this year coming into the country and having the kind of negative impact on prices, on crime, on the challenges that everyday Americans, especially Americans living in the poorest parts of America face on a daily basis.
So as you accurately quoted, I said over time. So I
Yes,
was
sir.
referring to the history, which with you agreed. So I was staying as far as I possibly could from the current political context. And, it's really not appropriate for us. We're independent. We like to remain that way. And the way we do that, one of the ways is by staying out of political issues that we really aren't assigned. And so the kinds of issues you're talking about are very, very real. I don't deny that, but they're really not for us.
So the Fed does not consider the impact of 10 million illegal immigrants coming to our country and the costs associated with those illegal immigrants, nor do they consider the impact on states like New York or California or Illinois, where the devastation of crime ravishing the poorest Americans has an impact. We don't take that into consideration.
So, we do, and so does the Congressional Budget Office, we do try to estimate population, and we try to estimate the effect of immigration, legal or illegal, on the size of the workforce and on GDP. If you look at the Congressional Budget Office has, as you probably know, a detailed assessment of all the things like that. We don't really have a way, and we do look at the finances in the aggregate of state and local governments, and the hiring that they do. So that's something we look at, but we wouldn't do a very specific assessment like that. I mean, CBO probably would, but we wouldn't do that.
Thank you.
Scott, Senator Menendez of New Jersey is recognized.
Thank you, Mr. Chairman. Before I begin my questions, I want to celebrate that in the past year we have seen the first Latino Federal Reserve governor and the first ever Latino Federal Reserve Bank president. These are historic milestones that show we are finally making progress, something that I have been at for quite some time, to the leadership of our economic institutions. So I want to applaud that. And Mr. Chairman, I hope that progress can continue and extend to the rest of the Federal Reserve staff.
Thank you.
I agree with my friend, the ranking member, that when you tell a story, you should tell the whole story. Mr. Chairman, are you aware of the Washington Post February 27th article that says the economy is roaring and immigration is a key reason?
I don't recall that, but I would have read it.
Let me read it to you. Immigration has propelled the U.S. job market further than just about anyone expected, helping cement the country's economic rebound from the pandemic as the most robust in the world. It goes on to say, economists and labor experts say the surge in employment was ultimately key to solving unprecedented gaps in the economy that threaten the country's ability to recover from prolonged shutdowns. Would you take issue with those statements?
There are a lot of adjectives and adverbs in there that you wouldn't see in Fed world. But the
Take out the adjectives and give me on the substance.
The story is, I think broadly, that there was a very significant increase in the size of the workforce last year, and it was happening all during the year, and we were wondering what it was. And the answer was it was really two things. It was labor force participation, but it was also immigration. And if you look at the Congressional Budget Office numbers, it kind of makes sense because there was a lot of growth. Wages were coming down. The economy is bigger. And those are probably in part effect. This is without making any judgments on immigration or immigration policy, but I think that's an economic fact.
I'm not suggesting that. I'm just suggesting the facts are that we had 10 or 11 million jobs that were going unfulfilled in our economy. They lacked the productivity that is necessary for success economically. And as part of that, clearly, immigration helped fuel part of our revival coming out of the pandemic. In fact, those were the people who were the essential workers when the rest of us were staying home. So I agree we need to do what is necessary to have a regularized border. But I also think that just to create the context of immigration as a scourge is absolutely wrong. Let me turn to another question. In my view, the sticky inflation we've been seeing in the housing sector is principally due to the massive nationwide housing shortage. The Fed's monetary policy report attributes the shortage to restrictive zoning, high interest rates, and tighter underwriting by banks. I would also add to that list underfunding of key HUD programs that shore up and expand our supply of affordable housing. If the housing supply shortage continues to grow, are we likely to see continued housing inflation?
Yes, we are.
And housing is already becoming less and less affordable for low and middle-income Americans. According to the National Low-Income Housing Coalition's 2023 Out of Reach report, a worker earning the minimum wage in New Jersey would have to work 2 full-time jobs to afford a modest one-bedroom rental home at fair market rent. Do you agree that increasingly unaffordable housing is a problem for the economy?
I think there are two things going on. One is a longer-term housing shortage, and the other is the pandemic effects and the associated higher interest rates, which are things that will pass through. When all that passes through and rates are normalized, we'll still have the underlying housing shortage, and it's going to be causing upward pressure on housing prices.
Now, the monetary policy report noted that, quote, home purchases by low-income households have fallen disproportionately more because mortgage lenders impose maximums on the ratio of a borrower's debt service payments to the borrower's income. I'm worried about how this dynamic will interact with the recently proposed capital requirements proposal, which, according to analysis from the Urban Institute, would disproportionately increase the cost of mortgages for Black, Hispanic, and low and income moderate borrowers. Given this, isn't there a risk that if the capital rules implemented without changes, that it could make it even harder for disadvantaged borrowers to attain home ownership?
There is a risk like that, and we're very focused on it.
And hopefully you're working to mitigate it.
Yes.
Thank you. Thank you, Mr. Chairman.
Thanks, Chairman. Senator Rounds from South Dakota.
Thank you, Mr. Chairman. Chairman Powell, welcome back. First of all, I've appreciated the way that you've approached the discussions in front of this committee, and I understand your desire to stay as neutral as possible with regard to the politics involved in an election year. But I do have some questions here, specifically with regard to the Basel III Endgame proposal. An analysis of that proposal found that 97% were either opposing it or expressing substantial concerns. In the hearing last March on the Monetary Policy Report, you stated that the Federal Reserve is a consensus organization, and you said, and I quote, I will do everything I can possibly to bring people together in consensus and have a capital framework that could be broadly supported. My question to that is, do you currently believe that there is a consensus on this capital framework?
I believe that we will have one. I'm fairly confident that we will have such a consensus when we do move forward.
So we could expect that you will probably not call a vote on the proposal until you believe that there is a consensus?
I think that's right. I mean, we're just in the process of digesting the comments and then making the appropriate changes.
Thank you. As you are aware, I've weighed in several times on the concerns that I have with regard to Basel III Endgame, including I'm concerned about the lack of transparency, the negative effects on mortgage lending and home affordability by disincentivizing banks from offering high loan-to-value loans that primarily help first-time home buyers and low to moderate income borrowers. I'm concerned that the proposal will make buying a home harder than it already is for many. And further down the road, I fear that it could disincentivize mortgage lending from the largest banks, particularly with regard to the secondary market and their impact on even smaller banks that do business with them. Would you be willing to withdraw the proposal or repropose with significant modifications, particularly addressing the concerns that I and others have on this committee, raising specifically with regard to the impact? And I'm thinking of Freddie and Fannie in particular and what the impact might be. What would you see as the process involving those particular issues?
So on those issues, we're well aware of and very focused on those issues. We haven't decided what to do about that yet, but we get it on those issues. In terms of process, we're not at the stage of making that decision. I will say if it turns out to be appropriate when we get to that point for us to repropose parts or all of the thing, then we won't hesitate to do so.
Okay, thank you. Makes me feel a little bit better because I do think there are some very serious problems that would occur if the Basel III Endgame as proposed goes into effect. And I most certainly am hoping that the Federal Reserve will find a consensus on this And it sounds like that may very well include some significant modifications if it were to be brought at all. Is that a fair statement?
I expect there will be material and broad changes to the proposal before it comes back to the committee for consideration, the board for consideration.
Thank you, sir. Let's just, with regard to the economy today, a limited level of price growth is believed to help facilitate economic expansion, reduce the risk of recession, and help businesses and consumers plan. However, during the Biden administration, we saw inflation climb to 13%, and those prices are now the new norm. I know that you make it a policy not to comment on the administration's fiscal policy, but it is well known that I really do believe that high inflation and high prices have been a direct result of President Biden's policies, failed in many cases, that the Federal Reserve has limited tools to address some of the problems that these policies created. We talk about supply side versus demand side on these costs. What have been some of the unintended consequences from raising the federal funds rate as rapidly as you felt that you had to as the chair and as the committee? What are some of those? I know that we talked a little bit about SVP and the failure there, their inability to look at treasuries and the increasing interest rates and so forth. But can you talk a little bit about some of the things that you've seen that were negative with regard to trying to respond to those high inflation rates?
Yes. So high interest rates are hard for businesses. They're hard for people. They're the thing they're the tool that we have to use to bring inflation down. And our job at this time, when high inflation comes, it is the Fed's job to restore price stability, and that's what we're doing. You point to the losses in banks. That was a very substantial thing, and obviously the supervisors, and that was us, didn't get to that problem. We were aware of it, but we didn't probably appreciate it enough. Another surprise, though, is that we were able to get this far and get inflation down this quickly without seeing a big increase in unemployment, and that's just a great result. That's just a surprise. It's not consistent with the historical record, but it's a really positive thing.
Thank you. And I would just know that the only tools you had available were demand-side tools.
Yeah, that's right.
Thank you. Thank you, Mr. Chairman.
Thank you.
Senator Warner of Virginia is recognized.
Well, thank you, Mr. Chairman. Chairman Powell, it's great to see you. I would point out to my good friend from South Dakota, I do think, if we'd gone back a year to 18 months ago, nobody would have predicted a soft landing. And I know you're not ready to declare victory by any means, but the fact that inflation has come down, and I actually think some of the things like the CHIPS bill, the infrastructure bill, and some of President Biden's policies have actually kept the economy growth rate at the levels that have allowed you to bring down inflation without seeing a dramatic rise in unemployment. And again, that'll be something we'll probably have the opportunity to litigate over the next 8 or 9 months. I want to take my time on issues around less about monetary policy and more about regulation. I think we can never presume that we're out of the woods on financial stability, as we saw with the New York Community Bank yesterday, the stock plunge and the capital infusion. One area that I raised with you a year ago, I want to re-raise today, and that is non-bank lending. The fact that non-bank lending in terms of to non-financial firms now is actually exceeding regulated bank lending. And let me be clear, I've got, the non-bank financial sector has done productive things in our society over the years. But when folks like former New York Fed President Dudley and former Fed Governor Grosvenor recently said that they had worries about this reliance on the non-bank financial sector could lead to overall economic lack of stability. I guess, what do you think, I've got a 3-part question. What do you think are the risks as we see this push-out effect of more and more lending going outside the regulated perimeter to the non-bank sector? How much do we really know about these institutions? And one of the things, they have very smart, sophisticated investors, but if those very smart, sophisticated investors said, well, hey, we don't like the lending profile right now, and we want you to not make any additional loans for the next 6 to 9 months, do you think our system would be able to pick up the slack?
So we have the regulated banking system where you've got a lot of transparency, you've got deposit insurance, you've got access to the discount window and all those things, regulation. If you go outside that, most of the funding that we see now in these vehicles is sophisticated investors who are actually limited partners, meaning they can't pull their money out. They've signed a contract, they've funded these deals. And so what you see now in the non-bank financial sector is significantly, it's that kind of thing. So it doesn't have the run risk. The point is, the bigger it grows and the more diverse it gets, it is happening outside the regulatory perimeter, and you worry that when there is another crisis, you'll be surprised, but there will be ways that financial structure too can break down, and it does break down in ways we don't anticipate. So I think we need to be smart about the way intermediation is absolutely moving out of the banks into the capital markets and into non-bank financial institutions. That's what's been happening for a long, long time. I just think we need to be thoughtful about understanding where the risks are emerging.
Right. And that sophisticated investor may rightfully say, hey, we don't want you to lend anymore for a X period of time, but that may then, at that moment of crisis, mean that the lending capabilities completely dry up. And one of the things I never completely understood until I got a little better explanation recently, why the large regulated banks weren't more complaining about this non-bank lending. But as I got to understand a little bit more of the, and again, I'm not per se criticizing on the non-bank lending, but many of the regulated banks actually lend to these large institutions, so they make money off of those relationships, and maybe that's again an explanation of why they're not being more critical. I only got 40 seconds left, but I would like to come back to another thing that we've talked about a lot, and that is the question of use of the discount window. I believe one of the original tools that the Fed had. I know banks say, well, we're concerned about the stigma. I've got some legislation that would actually require mandatory use of the discount window. I'd love your comment on that. And also just the idea that having the mechanics of the discount window open, potentially even 24/7, because we saw with SVB, they didn't know how to use it, but two, if they wanted to use it in the non-bank hours, could they get access?
There's a lot of work to do on the discount window. You're absolutely right. It needs to be brought up technologically into the modern age. We need to do more to eliminate the stigma problem, and we need to make sure that banks are actually able to use it when they need to use it. And those things. That's a broad work program that we're on right now, and it's very important.
I know you're working on it, but I would look forward to working more, and I'd invite other colleagues. I really do think before we start adding a whole host of the other regulatory issues, we ought to use some of the tools that are out there. You're not gone. So
God, I just checked in at the Veterans Committee. Senator Tillis, North Carolina. Thank you, Mark.
I was about to take control, Senator Warner. Welcome, Chair Powell, and Gus sends his regards. If you have time after the hearing, you ought to go by and see him. He's a dog in our office. But
I don't want to disturb his nap. But
but thank you for being here. I want to get back on this Basel III proposal. Senators Lummis, Coons, Gillibrand, and I sent a letter indicating our concerns with the current proposal. But I think it's also worth noting that the number of other organizations, a diverse group that are not normally aligned on policy. You got Bank Trades, National Housing Conference, NAACP, Habitat for Humanity, National Community Reinvestment Coalition, the list goes on, who have concerns with the current proposal. Here's my concern. I think we're trying to make the best of what was foundationally a bad proposal. And so I'm in the category of people who think that it should be reproposed, because I think one of the reasons why I did not support Mr. Barr's nomination is I felt like we were going to be here. I mean, it was pretty clear to me before he ever got confirmed on the board that we were going to be in this place some months or years later. And here we are. And I think that the industry felt the same way. All of these stakeholders, some of them are in banking trade, some of them are on the other side of the spectrum. So I'd like to cast my vote or provide some weight to the idea that we should repropose it. And what we ought to do is talk about the reality of increasing capital, or the prospect of increasing capital requirements doesn't concern me. I think the prior Fed supervisor had made comments publicly that maybe we needed to raise capital standards. But what we did hear in this proposal, and I heard in that dialogue, is let's deal with puts and takes. Let's talk about raising capital requirements, but let's also talk about reducing the cost of the regulatory burden today if we can do it responsibly. There's no evidence of that in the current proposal, and I think that may actually produce a different set of comments that would be instructive to a final proposal that I think realistically will include some increase in capital requirements. So over what time horizon do you think we would expect to either try to make the best of this foundation or go back and take a look at a new foundation and repropose it?
You know, we're going to work through it as quickly as we can and should. I will say it's more important to get it right than it is to do it fast. We're not in a hurry. But my guess is we'll work this out over the course of this year.
Yeah. Well, if you take a look at the outsized cost of operational risk, the long list of concerns that I have publicly and privately expressed on the current proposal, I do think sometimes it's easier to knock down what I think is a poor foundation and build a better house. So again, just wanted to make that comment publicly. I got a question about shrinkflation. I tell you, some of these words that we come up with, but President Biden's using the idea of shrinkflation and chastising manufacturers for creating smaller portion sizes for potato chips. I'll use that as one example. But if you have rising input cost, and you're not able to control that, and you're in a marginal business to begin with, and now you're saying you can't even reduce the quantities. How does a business that's not making a profit make that work?
You know, I mean, we see inflation at the aggregate level as a mismatch between supply and demand.
Yeah.
And as we've seen supply get better and we've seen demand cool off a bit, it was very hot coming out of the pandemic. We see inflation coming down.
We saw food inflation between 2010 and 2021 at 18% over 11 years. And over the last 3 years, we've seen it at 21%. I think that we have a industry that's trying to actually provide products that consumers want, and now they're being chastised for trying to figure out how to make the numbers work. So this whole idea of shrinkflation is just confounding to me. I'm going to submit some for the record. I want to stay on time. But I have a question. I think the chair mentioned, if I misunderstood this, I'm sure the chair will clarify, but I thought in his opening comments, he suggested that stock buybacks and paying out dividends were a key factor in inflation. Do you, as just a matter of policy, see stock buybacks and dividends as one of the top 5 reasons we're experiencing the inflation we have right now?
First, I guess I see stock buybacks and dividends as just the same thing in a different form. And I don't know, I wouldn't comment on anything the chair even may have said.
Yeah. Well,
I'd like to avoid that.
I don't think, I'm not going to ask you about policy because I think you're consistent on that, but I just can't imagine that if we decided to outlaw stock buybacks and dividend payments, that would have a material effect on inflation. So I'm not going to ask you to respond to that, but there are some people that by inference you could assume that they think that would be helpful. I just, for one, I'm not an economist, but I just can't imagine that it would be one of the things that would make your job easier. Can you at least opine on that?
Banning stock buybacks and dividends?
Yeah.
Yeah, I think that would be quite a change in our capital markets.
Yeah, me too.
I mean, shareholders, this is just money going back to shareholders from companies that have nothing to do with it.
Okay, thank you, Mr. Chair.
Well done, Senator Tilley. Senator Smith of Minnesota is recognized.
Thank you, Mr. Chair. And thank you, Chair Powell. It's great to see you here again. I appreciate your testimony. And I'm going to focus my questions on housing and housing affordability. As you have well pointed out, overall prices have moderated considerably since the Fed began raising rates, yet housing costs have remained stubbornly resilient or high, leaving us really no closer to addressing the affordability crisis that I think that we have, and this was there well before the pandemic. Shortly before the Fed began tightening, Chair Powell, and you came before the committee, I asked you about how higher interest rates could exacerbate this unaffordability problem that we have by making mortgages more expensive and also hindering housing development. And I think that at the time you argued that we have a excess housing demand during the pandemic, and that was kind of at the root of higher costs, and that your goal, the Fed's goal, was to bring demand closer in line with supply. So my first question is this. So the housing market has cooled significantly over the last 2 years. Is it your view that it has cooled enough so that housing supply and demand is better in balance? And following on that, given the Fed's limited tools, understanding that, at what point will you think that you've done all that you can to lower housing demand? My view is that we're well past time in Congress to take action on the housing supply side, but I'm interested in how you see this dynamic.
So we're not focused so much on housing and housing inflation. We're really focused on the aggregate, which is also goods and not housing services. That's way more than half of the PCE inflation. There are things in the housing sector that we didn't fully anticipate. One of them just was that people in very low interest rate homes with very low interest rate mortgages aren't selling.
Right.
So the quantity of homes that's available is incredibly low, and that's why it's very little in the way of existing home sales, and that drives up existing home sale prices, but also new home sale prices. So again, there's two sets of factors. There's the longer run issue, but then there's the factors associated with the pandemic and the inflation and our response to it. I think as the overall inflation continues to come down and rates then come down, you'll see the housing market start to heal and get better, and housing affordability should go up again. But you're still going to be left with the longer term problem of supply.
Right. I think that's right. I mean, what I see in Minnesota is that higher interest rates are, of course, driving up the cost of construction. They're driving up the cost of mortgage rates. You're seeing people who aren't leaving a house that maybe is a little too small for them because they can't afford it, that the housing, just as you're saying, people are staying in their homes longer. And so there's sort of this double whammy of construction slowing at the same time that there is this great need to address housing supply. One of the things that is happening, it's interesting, a recent analysis by Zillow found that the monthly mortgage payment let me get this right. A recent analysis by Zillow found that the monthly mortgage payment on a $343,000 home, assuming 10% down payment, is about $2,200 a month. Okay, so $2,200 a month. That means the cost of owning a typical home is higher than 30% of median income, which is kind of the measure of affordability. And so we've got a lot of issues with people just being priced out of the housing market. So from where I sit, the cumulative issues of higher mortgage rates are just really a challenge. And until we can get to the bottom of that, we're going to have a hard time addressing the housing affordability challenge that we have. Would you like to comment on that?
Yes, I agree with all of that. I mean, home prices don't actually go into the calculation of inflation. It's really rents and owner's equivalent rent. But I agree, the housing market is in a very, very difficult situation. And, the sooner we can get back to price stability and restore interest rates to lower levels, the sooner it can start healing.
Yeah, thank you. Thank you, Mr. Chair.
Thank you, Senator Smith. Senator Kennedy of Louisiana is recognized.
Mr. Chairman, thank you for being here. Thank you for your services. I think I've said before, I believe you and your team probably saved the world economy during the pandemic economic meltdown when the whole world wanted dollars by establishing the currency swap line. So I thank you for that. You gave an interview, Mr. Chairman, on February 4th of this year to CBS, 60 Minutes, I think. Is that right?
Yep.
I ordered a transcript of that hearing, which I read. I learned a lot reading it. You were asked a question about inflation, and you asked a question about prices declining. And here was your response. I'd like to quote you, if it's okay. Quote, so the prices of some things will decline, others will go up. But we don't expect to see a decline in the overall price level. That doesn't tend to happen in economies except in very negative circumstances. End quote. Did I quote you accurately?
I believe you did.
Okay. Later in the interview, you were asked about the national debt. Do you recall that?
I don't actually, but I'm sure that's right.
Okay. Well, at least according to the transcript, your answer was, and again, I'm quoting you, in the long run, the United States is on an unsustainable fiscal path. The U.S. federal government's on an unsustainable fiscal path. And that just means that the debt is growing faster than the economy. So it is unsustainable, end quote. Do you remember saying that?
I've said that many times. I think that's uncontroversial.
Okay. Later in the interview, you said, I want to quote, "You know, I would just say this, integrity is priceless. And at the end, that's all you have. And we plan on keeping ours," end quote. Is that an accurate statement?
Yes, it is.
Okay. That's why I want to ask you about the FDIC. Have you read the article in the Wall Street Journal entitled, quote, "Strip clubs, lewd photos, and a boozy hotel, the toxic atmosphere at bank regulator FDIC," end quote?
I think I did read that a couple months ago.
Did you read the article entitled, I quote again, "FDIC lawyer stayed on paid leave for weeks after child porn arrest," end quote?
I don't remember that one.
Okay, did you read the article entitled, also in the Wall Street Journal, quote, "FDIC chair, known for temper, ignored bad behavior in workplace," end quote?
Honestly, I don't. I read so much, I can't. I remember the broad story, but not particular stories.
Did you read the article in which a former female employee of the FDIC allegedly recalled her male colleagues saying women needed to use sex to get ahead at the FDIC?
I do not recall that. No.
Okay. Did you read the article in which a female risk management examiner during a lunch with a male examiner said she had become friendly with that examiner, and he complained to her about his marriage, allegedly, telling her he wasn't getting enough sex. And she allegedly said, quote, "Obviously, if I walked," or he allegedly said, "Obviously, if I walked into this office and you were naked, I'd fuck you right here," end quote?
I do not remember that, and I think I would.
Okay. Do you remember the article about Mr. Randall Ditch, a supervisory examiner in Denver, who allegedly was demoted in 2014 to a non-supervisory examiner position in Tulsa after having sex twice with a subordinate female employee and a number of other rule violations? In this article, it says, allegedly, Mr. Ditch had urged the woman to not, quote, "be a pussy," close quote, and drink a shot of whiskey during work hours, the records show. Do you recall that?
I do not recollect that.
Okay.
No.
Here's my question. I could go on for a while.
Could go on, but you're not going to go on. So you've passed your 5 minutes. Do your question once.
Sir?
Senator Kennedy, your time's already expired. You can do one. You did 5 minutes, consume the whole 5 minutes with your monologue of.
Well, you did 6 minutes. I timed it.
I asked my.
You did 6 minutes.
Senator Kennedy, for months, I have let you go way over the 5 minutes. You get your question.
But you did 6 minutes.
I chair this committee.
I understand. You still did 6 minutes. Check the record.
I'm going to order, you're going to be at 6 minutes and 15 seconds if you continue this argument, or you're going to ask your question.
I'll ask my question. I just wanted the record to be clear, Mr. Chairman. Mr. Chairman, in light of these allegations, if they're proven, How can the FDIC lead this charge for Basel Endgame 3, which is going to turn the banking community upside down?
I don't know how I would make the connection to Basel III. I'll say it's deeply troubling things, obviously, but again, you know, as your point was, if proven, and I mean, I think we have to decide Basel III on its merits, and we're not looking to the FDIC to lead this, by the way. We're looking at the Fed to do what the Fed thinks is right. That's what we're going to do. We don't look to, and they don't look to us to lead them.
Thank you, Chair Powell. Senator Butler is recognized.
Thank you, Mr. Chairman.
Thank you.
Senator Butler is recognized.
Thank you so much, Chair and Chair Powell. Good to see you in person, and thanks for the time to talk. I want to pick up a little bit where Senator Smith was in relationship to housing affordability, and hopefully draw a little bit on the point that you were making about rents. It definitely is an important crisis in my state of California, and I know across the country, where, at least according to the California Department of Housing and Urban Development, renters in San Diego are paying about 50% of what is, they're spending more than 50% of what is considered affordable. And statewide, the majority of renters, more than 3 million households, are spending more than 30% towards rent. Nearly 1/3, more than 1 in 5 million households pay more than 50% of their income towards rent. And the Chicago Fed President Goolsbee even referred to housing as a missing piece of the puzzle in the Fed's path to lower inflation. So to the continued conversation, and I know a point that you've made that about how inflation has a disproportionate impact on lower income households who are focused on spending more of their monthly budgets on housing. How is the Fed's monetary policy impacting the supply of affordable rentals?
I don't know that we're affecting the supply of affordable housing. If you think of affordable housing as something that's connected to some sort of government program, that's not our bailiwick. I mean, clearly interest rates do affect the affordability of housing, though.
And there was a key point that you made in an earlier, I think, reference about and in your response to Senator Smith about the monetary policy and the calculation of rents. Can you just spend just briefly talk about that? I want to have one last issue I want to get to before I run out of time.
It's hard to talk about it briefly. It's actually very conceptually challenging to think about housing inflation. Do you include the costs of financing it? Do you include the sale prices? And the answer is we don't. We convert ownership into an imputed rent, and that's 2/3 of homes are owned. And then we actually measure rents, but leases only turn over once a year, so you look at market rents, and what's happening with newly signed leases may be very different from what was happening a year ago. So it's complicated, but the good thing is we understand all that, and we look through that. We look at housing services overall as one of the 3 important categories, along with non-housing services and goods inflation.
Thank you for that. In the line of affordability and housing, again, sort of very general, I think, to the broad monetary policy and state of our economy, and unique to California. And I raised this with Secretary Yellen when she was here as well, the insurance gaps that are presenting themselves due to the impact of climate change. And where 1 in 5 residents in California live in areas that risk flooding, and all 58 counties have a history of flood damage. And we are seeing more and more insurance providers, home insurance providers, actually withdrawing from the state. You and I had talked a little bit about this in our preparation for today's conversation. Can you talk to me about or share with us how it is or what you think the impact might be of this sort of protection gap in insurance coverage on the overall stability of financial institutions in the broader economy?
So it is clear that insurance of various different kinds, housing insurance, but also automobile insurance and things like that, that's been a significant source of inflation over the last few years. And it's to do with a million different factors. It's nothing that we control from a regulatory or supervisory standpoint. In the longer term, companies are withdrawing from writing insurance in some coastal areas, and you got to think 10 years from now, how are you going to get housing insurance? And maybe the government will have to step in, but it's a significant issue.
Thank you, Chair Powell.
Thank you.
I was.
Senator is next. Yeah, Vance. Senator Vance of Ohio is recognized.
Thanks, Mr. Chair, and my gratitude to you and the ranking member for doing this hearing, and thank you, Chairman Powell, for being here. It's good to see you again. I think these hearings are always very important. Actually, give us an opportunity to sort of provide some oversight to what's going on at the Fed and better understand some of the things that you guys are doing that affect our constituents. Now, I wanted to sort of focus on the Basel III regulations, Chairman Powell, and specifically the way that they have. There have been various proposals to sort of draw them down to focus on the regional banks. And to just go back to sort of one of the most significant crises, obviously, in our banking sector, of course, the collapse of SVB and First Republic. You and I have spoken in private and I believe in public, but one of the concerns that I have is when we talk about increasing capital requirements on the banks, if the banks were under higher capital requirements in the run-up to the crisis, there's maybe an argument that SVB, for example, would have bought more long-term treasuries, which would have exposed their balance sheet to even more treasury bond risk. And that, of course, would have maybe hastened the collapse of SVB. And I guess I want to start here with, when we talk about, some of the Basel regulations, what was the original intent? In other words, what was the original sort of proposal for which banks would fall under those regulations and which would escape them?
You mean this time around, or earlier on?
This time around.
So it's the 37 largest banks. It's down to there's 4 categories of banks, including the G-SIBs, and this is down through the 4th category. The proposal that's out there now, I think, does extend to Category 4 as well as 3, 2, and 1.
So what's the minimum assets under management that you guys have proposed, the current
billion.
Basel regulations?
100 billion.
100 billion.
Yeah.
And sort of that sort of gets to my concern here, because I know there's some discussion about whether you'd apply them at $700 billion of AUM or $100 billion of AUM. And maybe you could just sort of walk me through that decision process at the Fed, where you guys are and what would sort of justify drawing down from a $700 billion threshold to a $100 billion threshold.
So there's the G-SIBs, there's the 8 identified G-SIBs, and then there's one category too, I guess, and then there are the big regionals, and those tend to be well-known big regional banks, and they're Category 3, and one of them's a 2, I guess, but they have a different tailored level of regulation, and then Category 4 had significant tailoring. And the question is, we have to ask the question, since SVB was a Category 4, we've got to ask the question, what, if anything, needs to be changed in the way they were regulated, supervised from a capital and liquidity standpoint. So there was tailoring all the way down. And then below 100, of course, those are community banks, and that's a different regime as well. This makes sense. We want to have a diverse banking sector. That's a great benefit to our country and very unusual for an advanced economy. So it's something we want to preserve.
Yeah, and I'm sure Chairman Powell, but just to put this on the record, I mean, a lot of the commercial lending, a lot of the real estate lending, a lot of the consumer lending, about half of that lending, consumer lending, is provided by the regional banks. I believe Huntington in my home state of Columbus is the #1 SBA lender in the entire country. So these, to your point, I think these do provide incredibly important benefits to our economy. And you hear a lot of people talk about the American economic miracle, and I do wonder if part of that is because we don't have the same type of financial system that has sort of dominated in Western Europe and in other first world economies. I'm curious, in the process of amending the Basel requirements, have you guys made a decision about where to set the threshold yet, and when do you expect to set that threshold?
We haven't made any final decisions. We put out for proposals some months ago, a proposal, and we've gotten a lot of comments, as I'm sure you're aware. We're chewing through those and digesting them, and we're just beginning now to sit down and talk about the changes that will appropriately make to the original proposal.
And when do you expect to sort of issue a final proposal?
I think it's going to take some time. I think it's more important to do it right than it is to do it fast. My guess is we'll get through this and be done over the course of this year. But it could be faster than that. It could be slower than that.
So I'm wondering, just being mindful of time, I have about 30 seconds left. Would you be willing to commit to say that in the process of amending, the Fed will remove the regional bank drawdown and limit Basel's application directly to the GSIBs or $700 billion or above?
I can't get that specific at this point, but we're clearly looking at the whole tailoring issue.
I appreciate that. And again, I just repeat, Chairman Powell, given what actually happened with the banking sector with SVB and First Republic, I just encourage you guys not to apply a regulation that doesn't actually solve the underlying problem. And I fear that if you apply this to banks of $100 billion and above, you actually are doing just that. So with that in mind, I'll yield. Thanks, Mr. Chair.
Thanks, Senator Vance. Senator Tester of Montana is recognized.
Yeah, thank you, Chairman Brown, and thank you for being here, Chair Powell. We appreciate your work in a difficult situation, but I think you've done a really good job, and so thank you for that. Look, at success at the Fed on your mandate for strong employment and stable prices is critical for small businesses on Main Street, for farmers, for ranchers, for Montana families. You follow all the metrics. From your perspective, where is the economy at now, and where's it going?
The economy's growing at a healthy, sustainable, solid, strong pace, and that's one thing. Second thing I'd say is the labor market is very strong and quite tight still. 3.7% unemployment for the last 24 months. That's the longest period since 50 years. And the third thing is inflation. Inflation was too high. It's come down very sharply since the beginning of last year. If you look at the 12-month number, the headline number has come down from the 5s down to 2.4. And the core number is at 2.8. I think it was at 4.9 a year ago. So these are big declines. So we're in a very different place, in a healthy place. We're going to use our tools to try to keep that strong economy, keep that strong labor market while we continue to make progress on inflation.
One of the areas where there has been inflation, and I don't exactly know where it's at now, but food rose quite rapidly. And by the way, I'm a farmer. We didn't get much of that. In fact, we didn't get any of it. Prices now compared to what they were a year ago are actually off. Compared to where they're 6 years ago, they're up. But compared to where they were a year ago, they're down. And so my question to you, Chairman Powell, is there anything you can do specifically to deal with food costs?
So as I'm telling a farmer his business, but if you look at the food cost to the consumer, part of that is commodity costs, and that was partly spiked because of Ukraine, grains and oil and that kind of thing. But the rest of it is a lot of costs in the supply chain, from when it leaves the farm to get collected and processed and trucked around and then put on the shelves and then the stores. All of those costs are just part of the general economy. So as the labor market cools off from its overheated status 2 years ago, you will see, and you have seen, food inflation flattening out. And so, the really high rates of inflation have come down. The prices, of course, have not.
Correct. I would just say that cattle's doing better. Grain actually has dropped in price at the farm gate, and I don't want to get into that debate with you at all because we probably agree, but it'd take too long, take too much time. We got other stuff to talk about.
I'd be learning from
you. You've discussed in previous hearings the impacts that the pandemic, shutdowns, and supply chain issues have had on economies globally. How does the U.S. economy look today compared to our competitor nations, particularly China?
Well, I start with the advanced economies. We're doing the best of anybody. We've got the strongest growth and the lowest inflation of the advanced economies. China is a whole different story. China is having significant difficulties with its economy right now, and they're in a very different place than we are.
And so, to repeat that, what I heard you say is that the economy of the United States is basically in better shape than any other economy in the world?
Any other major economy, yes.
Yes, okay. Look, one of the other challenges out there is housing in communities all across this country, whether you're in Montana, whether you're in a city in Ohio. Workforce housing in particular is a top priority, top commodity, so to speak. Plenty of folks, great organizations are working to address this. I meet them every day, and I appreciate the work they're doing. But how do these housing supplies issues show up in the data that the FOMC uses to make decisions?
So housing prices don't go into the data. Housing starts and renovations and things like that are just business activity, and that shows up. But when it comes to inflation, we convert ownership into an imputed rent, and then we look at rents. Okay. And so that's how we look at all that. So we're not directly affected by changes in housing prices, but over time those will drive rents up.
So is it fair to ask, are there economic trends that you see for housing?
Yes. So there's two big things going on. One is we have this underlying shortage of housing, and it's due to things like difficulties of zoning. A lot of the close in to cities, places are already built, and so more difficult to get zoning, more difficult to get people and materials and all that. That's one thing, and that's not going away. Then there's just a ton of things happening because of the pandemic, because of inflation, because of higher rates. And those are, in the short term, those they're weighing on the housing market. But as rates come down and that all goes through the economy, we're still going to be back to a place where we don't have enough housing.
Well, once again, thank you, Chairman Powell, for your work. I very much appreciate it. Thank you, Chairman Brown.
Thanks, Senator Tester. Senator Kramer of North Dakota.
Thank you, Mr. Chairman. Chairman Powell, good to see you. Thank you for being here. It's been a rather uneventful couple of days for you, considering you've spent 2 days in this place. And I'm not going to upset that, by the way, just so you know. But I did appreciate your response earlier to Senator Scott when he asked about immigration, and you said the Fed hasn't been assigned that. So I want to bring up something else you haven't been assigned to that you and I have talked about over the years, and that, of course, is climate, the role of climate in your job, the role of climate risk in banking. And you've often said, I think the most common statement was, we should stick to our knitting, I think is one of yours, stay in our lane, similar to what you said probably to Senator Scott. But that said, in October, the Fed, the OCC, the FDIC issued climate guidance, as you know, for management of covered institutions. And so I'm just kind of curious, did Congress somewhere along the line give the Fed authority over climate policy as well? Or is that another one of those things that somebody just took on? And I realize you're not the dictator of the Fed, only the chairman of the Fed. But I'd be interested in, as the chairman, your views on it.
Our assignment is the safety and soundness of banks, and that they understand and can manage the risks that they face. That's our assignment. And we said in climate world we would do two and only two things. One of them was to do illustrative stress scenarios, scenarios, not stress scenarios, climate scenarios, so that the banks are already doing this. The large banks who are subject to this, they're already doing it because they're doing business internationally and they don't have any choice. So we said we'd do that, and we also said that we'd offer guidance on not on level of climate risk or anything like that, just on what you had to do to be in a position to assess. And that's, for my thinking, that's it. That's what we're doing. And we're not doing it. There are no new initiatives. We're not going to change our capital requirements to reflect climate risk or anything like that. I'm really determined that we are not a climate policymaker, and that is really the business of elected officials.
Very good. Thank you. I'm going to bring up one other topic I don't know that's been brought up today, and that's central bank digital currency. I think from a lot of my friends out there, I think I know there's some confusion. I mean, I'm easy to confuse, but there are a lot of people that get confused about what is meant by the administration's, admonition to continue researching, experimenting, looking at some sort of central bank digital currency. I think people back home look at that and go, "Oh my gosh, they're going to control this now." And could you maybe just differentiate a little bit what people think of in terms of a Bitcoin or their held digital currencies versus what a central bank digital currency, who, in my view, should emulate cash, right? It still should be about the dollar, not about some different kind of currency. Could you just sort of help people back home better understand why they shouldn't be quite so frightened?
First of all, I want to say that we're nowhere near recommending or let alone adopting a central bank digital currency in any form. But the idea is that as technology has evolved, money has become digital. So But the government doesn't issue digital money. It's digital. If you look at your bank account, people don't hold those physical dollars. They're digital. So the thought was that the government could create a digital form of money that people could then transfer among themselves. Now, of course, that raises a concern that if that were a government account, that the government would see all your transactions, and that's just something we would not stand for or do or propose here in the United States. That is how it works in China, for example. But that's not what if we were to ever to do something like this, and we're a very long way from even thinking about it, we would do this through the banking system. The last thing we would want, the Federal Reserve would want, would be to have individual accounts for all Americans, or any Americans for that matter. Only banks have accounts at the Fed, and that's the way we're going to keep it. So it's just really, it's a question of following technology as it evolves, and in a way that serves the public better. People don't need to worry about a central bank digital currency. Nothing like that is remotely close to happening anytime soon.
That was very helpful. Thank you, Mr. Chairman. Thank you, Chairman.
Senator Kramer. Senator Cortez Masto of Nevada is recognized.
Thank you, Mr. Chairman. Chairman Powell, great to see you again. Thank you for all of your good work. I want to talk a little bit about the commercial real estate and what's happening there. The Financial Stability Oversight Council's 2023 annual report identified commercial real estate as a financial risk. And the Fed's monetary report also noted commercial real estate prices continue to decline, especially in the office, retail, and multifamily sectors. I'm especially concerned that because of the low levels of transactions in the office sector, prices have not yet fully reflected the true decline in the value. So can you expand on the emerging risks the Federal Reserve has identified in the commercial real estate market, one? And then I'm curious, can you discuss the compound risks identified in commercial real estate lending, particularly at banks with large CRE concentrations and high fractions of uninsured deposits?
Sure. Let me say, I think there are just very, very few transactions in commercial real estate right now, particularly in the troubled areas. So it's not a question of prices still falling. It's a question that you don't have that kind of price discovery. You just have to assume that the prices are very low and have come down a lot. So on commercial real estate, we have a secular change in people working from home. This is one big part of it. That means that in many cities, the downtown office district is very underpopulated. There are empty buildings in many major and minor cities. It also means that all the retail that was there to service the thousands and thousands of people who work in those buildings, they're under pressure too. And banks will have made loans to many of those buildings. Not all of them, but many. So this we've known for some years. And so what do? We have identified the banks that have high commercial real estate concentrations, particularly office and retail, and other ones that have been affected a lot. We identify them, and we are in dialogue with them around, do you have your arms around this problem? Do you have enough capital? Do you have enough liquidity? Do you have a plan? You're going to take losses here. Are you being truthful with yourself and with your owners? And so we've been working with them. And so for some time we've been doing that. And this is a problem that we'll be working on for years more, I'm sure. There will be bank failures, but this is not the big banks. If you look at the very big banks, it's not a first order issue for any of the very large banks. It's more, smaller and medium sized banks that have these issues. We're working with them. We're getting through it. I think it's manageable is the word I would use, but it's a very active thing for us and the other regulators, and it will be for some time.
Thank you. Do you have concerns? Let me just ask you this. As you're talking with these small and medium-sized banks, because we know there's always could be a contagion, which we've seen in the past, do you have concerns that if they fail, that somehow this is going to impact the financial sector? And are you prepared and trying to address that and prevent that from happening?
We're trying to stay ahead of that. So we also reached out to banks that had high concentrations of uninsured deposits, and particularly uninsured deposits, and a lot of commercial real estate in the office sector. So we're well aware of that issue, and we're just trying to stay ahead of it on a bank by bank basis and overall.
Okay.
And so far we've been able to do that.
Thank you. Let me jump to another issue that has been on my radar. The Federal Housing Finance Agency's report on the federal home loan banks concluded that the distinction between the FHL bank's role and that of the Federal Reserve discount window as lender of last resort has not been clear, especially during times of market stress. During the 2023 banking turmoil, we saw banks rely on advances from the Federal Home Loan banks and didn't even have relationships with the Federal Reserve to use its discount window. I know you've talked a little bit about this with Senator Warner, but how is the Federal Reserve working with the Federal Home Loan banks to ensure that banks establish protocols to borrow from the Fed's discount window prior to times of stress?
So we work with the Federal Home Loan banks because in many cases, banks were moving their loan from the Federal Home Loan Bank to the Fed. So we need to have smooth transfer. We need to be in good touch with them. Even more important than that, though, is that banks, any bank in the United States, needs to be in touch with the discount window, know how to be able to access it, have appropriate collateral, have control of that collateral. You know, in many cases, it was incredibly inefficient and took a long time for banks to actually go through that function. The Federal Home Loan banks are actually ahead of us in technology. We know that we need to really invest in technology to modernize the discount window, and also we need to do more to get our banks, all of them, in touch with the discount window in a way that they can use it quickly should they need to do so.
Thank you.
Cortez Masto. Senator Haggerty of Tennessee is recognized.
Thank you, Chairman Brown. Welcome, Chairman Powell. Under your tenure, Mr. Chairman, the Fed has taken the stance that the 2% inflation target shouldn't be viewed as a snapshot in time, but rather it needs to be achieved, quote, sustainably. When inflation was running well above the 2% target back in 2021 and early 2022, the Fed was patient and allowed rates to offset the below target inflation that had occurred in the years prior. It strikes me as odd now that while we're still well above target inflation and have been well above for the prior year, markets seem to expect the Fed to immediately cut even before we've breached the 2% inflation threshold. So my question is this: if the inflation rate reaches 2%, would that be considered a return to the target rate on a sustainable basis? Or is it still the case that inflation would need to more or less overcorrect to well below 2% before the Fed makes the rate cut adjustments?
So it would take us a while to really get comfortable that inflation had settled in sustainably at 2%. But that's not our test for changing interest rates. Interest rates right now are well into restrictive territory. They're well above neutral. And we've said we would not wait for inflation to get down to 2% because if you wait that, monetary policy works with long and variable lags. So we've said, for some years that we would start restoring the federal funds rate to a more normal, almost neutral level. We're far from neutral now. Yeah. And so, we do plan, assuming the economy moves along the lines we expect, we do plan on starting the process of dialing back restrictions.
I'm just trying to look for the symmetry. I know we sort of allowed the economy to overshoot when inflation was high, and we sort of made up for prior years of low inflation. I'm trying to square that with the fact that
we didn't actually do that. We adopted a framework that said we would do that, but then we got suddenly, a few months later, we got almost an explosion of very high inflation. That's not what we were looking. We said, moderately above or modestly above 2%. This was not modestly above 2%, and we reacted. We thought that the mistake we made was we thought that inflation would go away.
That it was
quickly,
transitory.
Which means it goes away quickly without effort by us. We figured out at the end of 21 that was not the case, and we acted.
And you don't see that same abrupt dynamic coming the other way. You're more comfortable.
No,
with
I think we're in the right place, which is we're waiting to become more confident that inflation is moving sustainably at 2%. Mm-hmm. When we do get that confidence, and we're not far from it, it'll be appropriate to begin to dial back the level of restriction so that we don't, drive the economy into recession rather than normalizing policy as the economy gets back to normal.
Yeah. Can we go to the balance sheet and talk about that? We've seen a dramatic expansion of the Fed's balance sheet over the past couple of decades. In 2005, it was at $800 billion. It's at $7.5 trillion today. It's doubled since the pandemic was underway. And through quantitative tapering, the Fed is attempting to reduce its footprint. And the concern I have is, on the other hand, government spending tends to just continue to be profligate. We're running now $1 trillion deficit every 100 days, and we're flooding the market with Treasury debt, and we're putting upward pressure on interest rates as a result. And what I think that is lost on many of us here is that the spending levels will only make your job harder when it comes to lowering interest rates, not to mention there's a tacit expectation that the Fed will step in once the markets can no longer absorb our new issuance. I think this is a very serious problem. I think it deserves more attention. And I think we're now at a point where your objectives may be, very much at odds with the behavior of our fiscal policy. Am I missing something here, Mr. Chairman, or does increased net issuance by the Treasury lead to higher rates?
I mean, in principle, more supply should lead to modestly higher rates, but that's not going to affect what we do. That's not a problem for us. Our balance sheet normalization is running very much as expected. We've decreased the size of our holdings by almost $1.5 trillion.
I hear you. I think it's troubling that we continue to put fiscal pressure by continuing to put, again, we're running a deficit of $1 trillion every 100 days, and the issuance is required to deal with that. We're putting a lot more pressure, I think, on the Fed. And again, making your job harder. I think we need to take that into consideration. Another component of this topic, your colleague Governor Waller said he'd like the Fed to shift its holdings toward a larger share of short-term treasuries. Back prior to the financial crisis, about a third of the Fed's holdings were in bills. Now they're around 3% of your total securities holdings. Do you share the goal with Governor Waller? And if so, how long will it take us to get there?
Take a while. That's an issue. We're in our FOMC meeting in a couple of weeks. We're going to have our first really deep dive on what to do with the balance sheet. That's one of the issues. I don't think we'll deal with that at this meeting, but over time, you'd love not to own a lot of MBS, and I can see a case for shortening the maturity, but it's not something that would happen quickly, and we're not actively looking at that. That's sort of a longer term aspiration that I think he was.
Just one final point, Mr. Chair, and you and I have talked about this before. We're in an election year. You're getting a lot of pressure. I hear it from lawmakers to adjust rates. I'm not telling you to raise rates or lower rates, but I'm just here to emphasize the fact that the credibility of the Fed depends on your remaining data-driven. The credibility of our currency as the reserve currency of the world depends on that, and I encourage you to continue to maintain that posture. Thank you.
Will do.
Thanks, Senator Haggard. Senator Warren of Massachusetts is ready.
Thank you, Mr. Chairman. So it's been a year since we had the second, third, and fourth largest bank failures in American history. Greedy bank executives were part of the problem, and the Fed, as the chief regulator of the biggest banks, was part of the problem. Under your leadership and direction, the Fed steadily weakened rules for the biggest billionaire banks, exactly the banks that failed last March. In other words, Chair Powell, you failed to do your job to keep these big banks in line. Now, when these banks blew up, you went into spin mode, promising that the Fed would do better. After years of hemming and hawing, you finally agreed to put in place Basel III rules that would strengthen capital standards for the biggest banks. And I mean the biggest banks. These are the Fed's proposed rule would apply to only 37 of the nation's 4,500 banks, only the banks that have $100 billion or more in capital. Now, Chair Powell, when you testified before this committee last June, I asked you about taking responsibility for bank failures. And you said, quote, "The main responsibility I take is to learn the right lessons from this and to undertake to address them so we don't have a situation like this where we had unexpectedly a large bank fail and spread contagion into the banking system," end quote. And as part of learning those lessons, you also said, quote, that you agree with and support, end quote, Vice Chair for Supervision Barr's recommendations for strengthening the Fed's rules and supervisory practices for the big banks, and that you're, quote, confident they will lead to a stronger and more resilient banking system, end quote. So I just want to be clear. You haven't backed down from any of your comments from a year ago, have you, Chair Powell? Right lessons, don't let this happen again, supporting Vice Chair Barr's recommendations, which include stronger capital standards.
No.
You still stand by all that?
Yeah.
Good. I'm glad to hear that. Now, I understand that those 37 big banks don't like higher capital rules because they are like insurance. You know, they would make the banks safer, but they cost a little money and would nip into the bank's profits. So these 37 banks are swinging their very considerable weight around to try to weaken the capital rules. They've spent tens of millions of dollars running ads during Sunday night football and millions more for an army of lobbyists to try to twist arms here in Congress. Impressive spending, but who exactly are they trying to impress? A man on the inside? You know, despite all you said last year when the banks failed about supporting Vice Chair Barr's recommendations to strengthen rules for big banks, public reporting now says that you are driving efforts inside the Fed to weaken the capital rule. You even told the House Financial Services Committee representatives yesterday that you think it's, quote, very plausible, close quote, that you withdraw the rule. As one analyst put it, quote, I don't think they will pass a final rule without Powell's support, suggesting that the rules will have to be weakened, quote, to appease Powell. So, Chair Powell, I'm having trouble reconciling the statements you made last year, which you say you hold on to, statements you made when the headlines were all about 3 giant bank failures, and now your reported efforts to quietly weaken the rules that would strengthen capital standards for giant banks and prevent more bank failures. So let me just give you a chance to clarify the record here. Are you committed to finalizing the strongest version of the Basel III capital rules this year?
Let me first say that we have taken and are taking many more steps to deal with the problems that revealed themselves with Silicon Valley Bank, and that's around supervision. We'll have a strong liquidity.
I appreciate that, but I'm just asking about the Basel III rules, the ones that you have been required for years now to put in place and have dragged your feet on.
The Basel III rules are not directly related. They're not the thing that is directly related to Silicon Valley Bank. As you point out, they're a longer run thing, and I would just say that we put them out for comment. We got the comments. Anybody's free to go read the comments. My view is that it will be appropriate to make material and broad changes to that before we finalize it. And in terms of, I didn't say that...
Material and broad changes to strengthen the rules?
Material and broad changes, and we're talking about what that'll mean in the end. I did not say that we would withdraw the rule. I said, there's a concept of reproposal, and I said we hadn't made a decision on that, but that if that turns out to be appropriate in the view of the Board of Governors, then that's something we would look at doing.
So everything you said a year ago about supporting the vice chair who is responsible for writing these rules?
You and I had a long colloquy.
Yes, we did.
If you read it again, it's on your website.
And I have.
You will see that I'm doing exactly what I said I would do in that colloquy.
You said you would support Vice Chair Barr to get us strong rules, and now he is putting out rules, and you're talking
Silicon
about
Valley Bank. The Vice Chair for Supervision has every right to bring proposals to the board. That has happened, but as I made clear in our colloquy, you're not the comptroller of the currency. When I do monetary policy, I have one vote. There are 11 other voters, and that's the way it works. It's not different for the Vice Chair for Supervision.
You are the leader of the Fed, and when the heat was on last year, you talked a lot about getting tougher on the banks, but now the giant banks are unhappy about that, and you've gone weak-kneed on this. The American people need a leader at the Fed who has the courage to stand up to these banks and protect our financial system. Thank you, Mr. Chairman.
Warren, Senator Daines of Montana is recognized.
Chairman, thank you. Chairman Powell, thanks for being here. Good to see you. I can tell you Montanans are continuing to see the impacts across the board from inflation that's been brought on by the policies of this administration and by my colleagues across the aisle. And I commend you for the job you have done in trying to rein in inflation, and I encourage you to continue the fight despite political pressures you may face. Last time I checked, it's going to get a little more political around here between now and November. I'm also encouraged, contrary perhaps to my colleague from Massachusetts, I'm encouraged by your comments yesterday that there will be broad changes to the Basel III proposal, which, as it's currently proposed, would have significant detrimental impacts to credit cost and availability to small businesses. And lastly, I commend your answer yesterday that the Fed is not a climate agency, and considering the impact of climate change is not a factor in achieving your given mandate, congressional mandate, of maximum employment and stable prices. Mr. Chairman, I recently joined many of my colleagues in writing to you about my concerns about the long-term debt proposal that would mandate regional banks issue new long-term debt. I'm concerned that this will have a disproportionate impact on smaller regional banks because they're required to hold their long-term debt at both the parent holding company and insured depository bank levels. Could you explain how this aligns with the tailoring requirements set forth in the financial reform bill that we passed back in 2018, Senate Bill 2155?
So how the longer-term debt proposal aligns with that? Mm-hmm. So first of all, that's been out for comment on that one. The comments are in. We're reviewing it. So I don't want to say too much, but the theory of it in the first place was that those banks are not subject to the living will process to the extent that the GSIBs are. And this was sort of meant to be a middle step to make them more resolvable without imposing all of the burdens that we impose on the 8 GSIBs to have very elaborate resolution plans. So that was the thinking. I think on the calibration of it and all that, we have voluminous comments. We're looking at them, and we'll make an assessment and move forward as appropriate.
Well, thank you. And I know our smaller regional kind of banks would be happy to hear that thoughtful deliberation, Mr. Chairman. Understandably, you've had to raise interest rates to fight the fires of inflation brought on by reckless Democrat spending. However, a major side effect of that is the impact the rising rates are having on the cost of servicing the out-of-control national debt. Senator Hagerty alluded to this a bit in his questioning minutes ago. Looking at CBO reports, interest payments on our debt will increase 32% this year and will now exceed spending for the entire Defense Department. I have significant concerns, many do here in Washington, many Americans do, that we eventually reach a point where fiscal policy and monetary policy converge, meaning that the Fed would ultimately have to worry about the impact rate setting would have on government debt or even potentially the risk of a default. Chairman Powell, I know fiscal policy is not in your purview, but could you ever foresee a situation where fiscal irresponsibility snowballs to a point that the Fed would have to factor this into its decision-making?
I think we're a long way from that, and that's a real that's a terrible place to be. That's a place where some poorer emerging market countries have found themselves over the years. For the United States to get to that point, I think it's unlikely. But I do think that, and it's not our business, we should stay out of this fiscal business. But I'll say what other Fed chairs have said, which is we really need to get back to that discussion about fiscal sustainability, and both sides need to get together. The kinds of things that have to happen can only be done on a bipartisan basis. And so I really hope that we go back to a place where those discussions are happening again.
I've heard from a number of stakeholders about upcoming changes to liquidity regs, including a new ultra-short-term liquidity requirement. As with any policy decision, establishing the facts matters. It's important that financial regulators have a complete, thorough understanding of the financial environment before releasing a half-baked proposal, rule, or guidance. My question is, what do you believe is a sufficient time period that would allow your agency to accurately calibrate new sound and reasonable liquidity requirements?
That is a great question, and one we're struggling with, particularly with all the other things that are going on. We're looking at some, and this is in response to Silicon Valley Bank. We're looking at some liquidity innovations, and we're asking ourselves, what form should that take, and how long should it be out for comment, and that sort of thing. We're not ready to do that yet, but that's the question we're asking.
Follow-on question, and I'm finished, Mr. Chairman. will you confirm that prior to the Federal Reserve issuing any new liquidity requirements, it will first conduct all necessary data collection that would allow for meaningful analysis of all potential policy options?
And please keep your answer short, Mr. Chairman.
Maybe. No,
That's very short. Thank you.
I can't, we can talk about this more, but I don't want to make a really specific commitment like that without talking to the people who are, carefully in touch with this. But that is the right thought.
Thanks, Chairman.
Thank you. Senator Fetterman from Pennsylvania is recognized. Well, he got here last.
Nope.
So, although if Senator Warnock sits down in the next 5 seconds, he's next. So, Senator Warnock, are you ready, or you want to go to War 5? You're all so generous with each other. Senator Fetterman's recognized.
Okay.
All right. Senator Warnock is recognized from Georgia.
Thank you, Chairman. Banks.
Thank you very much, Mr. Chairman. Bank spending on buybacks is rising again, and their consumer small banking revenue has sharply increased. Interest rates are high, yet the interest being paid to depositors, ordinary working families, working people with bank accounts. Not a lot of money in Wall Street accounts, remains low. Chairman Powell, I'm concerned that when banks don't increase the interest rates on bank accounts, families are losing out on dollars that could be in their pockets. Again, they don't have the kinds of portfolios that some of the folks in this room would have. Is that good for the economy? And are you concerned that banks under your supervision are doing this?
Are not paying sufficient.
That's correct.
That's a question I haven't heard. Of course, they have the option of putting their money in money market funds, and banks compete with each other. But I'll be happy to look into that. I hadn't heard that concern.
Yeah, and I think it is worth taking a look at. Many lower income individuals and families, again, they don't have some of the sophisticated products yet. Money markets are available, but we saw high interest rates and that not being reflected in what depositors are able to benefit from. Could those individuals and families benefit from a high interest rate on their deposits?
Sure. And, it's for a long time, we had a lot of mail from people at the Fed to the Fed saying, you should raise interest rates because we're not getting anything on our checking accounts. So we solved that problem.
I don't think we're asking for that, but given the reality, the question. Yeah. So let me pivot. The Monetary Policy Report states that while demand for housing has fallen, a strong labor market has kept prices high. That matches what I've been seeing in Georgia. Too many folks can't afford a home. According to the Monetary Policy Report, mortgage rates were averaging around 7% last month. That's tough for lower income home buyers. Increases of just a percentage point or two can be the difference between owning a home or not. Are you concerned about this interplay between lower demand yet stubbornly high prices and what it means for folks trying to buy a home? And what do you think is driving these high prices?
So the housing market is in a very challenging situation right now. You have this longer run housing shortage, but at the same time, you've got a bunch of things that have to do with the pandemic and the inflation and our response with higher rates. So you have a shortage of homes available for sale because many people are living in homes with a very low rate mortgage that they can't afford to refinance, so they're not moving, which means the supply of regular existing homes that are for sale is historically low and very low transaction rate. That actually pushes up prices of other existing homes and also of new homes because there's just not enough supply. The builders are busy, but they're running into all kinds of supply issues still around zoning and workers and things like that. So it's quite challenging. And of course, rates are high. So people who are buying, a lot of the buyers are cash buyers or are able to actually pay without a mortgage because mortgages are expensive. I will say the first problem, the longer run problem of supply, is a longer run problem. The other problems associated with low rate mortgages and high rates and all that, those will abate as the economy normalizes and as rates normalize. But we'll still be left with a housing market nationally where there's a housing shortage.
There's no question we have a supply issue, and this issue of high prices, lack of supply, of course, disproportionately impacts some communities more than others. According to the Monetary Policy Report, the employment rate for the Black prime-age labor force, that is, persons between 25 and 54 years of age, reached a historical peak in 2023. The gap between Black and white prime-age employment dropped to a nearly 50-year low at around 3%. We can appreciate progress, but a 3% gap is still significant. Would you agree that it is important to continue focusing on narrowing this gap? And if so, what tools does the Federal Reserve have to do this work?
It's very important, and the single best thing we can do is get prices under control, get inflation under control, so that we can have a long expansion with, the record is clear that a long expansion really gives significant benefits to people at the low end of the income spectrum, because the labor market gets very tight, inflation is low, and they benefit more than anybody. So that's where we were before the pandemic, and we'd like to get back to that place.
Thank you so very much. I think there are some other legislative tools that Congress could use, and I'm happy to continue to work with the chair in the ways that we've already done to improve that difference. Thank you.
For sure. Thank you, Senator Warnock. Senator Lummis from Wyoming is recognized.
Thank you, Mr. Chairman. Welcome. It's nice to see you, Mr. Powell. My first question is about CBDCs. There's been some chatter lately on the social media that people are concerned about the Fed creating a CBDC without legislative authorization. You and I have discussed that before, and as you know, there are other means other than a CBDC that could use digital assets to create a secure and instant payment system other than a CBDC. So the question is this: do you still agree that the Federal Reserve cannot introduce a U.S. central bank digital currency without congressional authorization?
Yes, I do.
Thank you. That's really calms people's fears, the people who are concerned that we could end up with something like the digital yuan that is used as a means of surveillance. So I think that will calm some of those discussions down. Thank you so much. My next question is about your core CPE. Now, as you know, there's a disconnect between how you measure inflation and how the American people see inflation, because the American people are spending their money on gasoline and food and rent, things that have gone up a lot. And they hear about these improvements in the economy that they're not seeing in their everyday lives. So can you explain what measures you use to evaluate inflation, and just explain to the American people why you don't factor in the things they spend money on every day, like food and gasoline?
Actually, we do. Our statutory target is inflation. It's not core inflation. So, and if you look at headline inflation over the last 12 months, that's it. That's our goal. It's 2.4%. Core inflation is actually higher than that. It's 2.8%. And the reason is that some energy and food prices have come down, and those don't count in core. So our overall legal target is headline inflation, which is, it's our best effort to capture the cost of living that people face. It's not perfect. You have to make all kinds of judgments that aren't easy. I mentioned that housing earlier. How do you measure housing inflation? Lots of issues, but that's what we target. The reason we look at core, though, is that headline inflation tends to be more volatile, and it tends to be pushed around by commodity prices, which really don't relate to the overall state of the economy. Is it tight? Is it loose? So core tends to be a better predictor of overall inflation than overall inflation is. I know that's complicated, but Ultimately, though, our target is headline inflation, which does include food and energy.
Mr. Chairman, I'd like to include a letter in the record that Senator Tillis and I and 2 Democrats on this committee have submitted with regard to Basel III. My question...
Without objection.
Thank you very much. My question is this. What do you think is more likely, that it will be harder for consumers to buy a house and small business to obtain a loan under Basel III, or will lending just migrate outside the banking system, which may be harder to assess because it's opaque?
I'm sorry, I didn't get your question. I apologize.
Okay. So with regard to Basel III,
Yeah.
If there are more constraints on lending activity, what is more apt to be the consequence of that? That it's harder for consumers to buy a house or a small business to get a loan, or that lending just migrates outside of the traditional banking system?
So if there were anything that constricted credit in the banking system, they would probably be both things. Probably there'd be fewer loans made, but in addition, there would be non-bank lenders that are more than happy to make that loan.
I have a chicken and the egg question here. Starting with TARP in 2008, there has been a very aggressive printing of U.S. dollars up until today, and it particularly went on hyperdrive during that 22-month period of COVID. So my question is, which comes first? Congress spending more, and so you respond by printing more money, or are they separate considerations?
I think it's hard to get my mind around that question. We don't print money to fund the deficit. That's not what happens. But when the government borrows, it issues, basically the government borrows to fund deficits is what happens.
Right. And so so that would indicate to me that you do respond, because we, in deficit spending, are creating a demand to borrow, and you're responding by...
Well, we're not making loans, though. You know, we're not lending money to the government. We're not financing these deficits.
And so there's no chicken and the egg relationship?
There's not really, no. I'd have to think about this. I got to think about the way the plumbing. Why don't we continue this?
Yeah, I'd love to. And your thoughts earlier about fiscal sustainability and how we can work with you and bipartisan, maybe next year, to address these issues. You know, when you say things, you have to be careful, because what you say has ripple effects outside of this building. But it would sure be nice if we could sit down with you on a bipartisan basis and have those discussions in a frank way.
Thank you, Senator Lummis. Senator Fetterman of Pennsylvania is recognized. All right, Senator Van Hollen of Maryland is recognized.
Let me start by thanking Senator Fetterman for his allowing me to question him. Mr. Chairman, good to see you. Real wages are up, right? That's good news.
Okay. Yes, over the last couple of years, wages have been going up more than inflation. Real wages broadly are up.
That means more families have more spending power in their budgets, right?
Yes.
Worker productivity is up, right?
Yes, it is.
Corporate profits are up, right?
I believe so.
And worker productivity is rising faster than corporate profits, right?
I don't know the answer to that. That may well be right.
The charts I show suggest that. So that would indicate that unless corporations decide to pocket as profits more of the gains they get from their workers' labor, that we should be able to continue to have increases in real wages. Is that right?
Yeah.
And so it's important, I think, that people recognize that these corporations are doing better than ever, and they are deciding now to essentially return the gains made through their workers' productivity, which is going up, more to shareholders. Obviously, shareholders are going to get a profit, but the question is whether or not workers share in that profit to the extent of their worker productivity. And as you know, we've seen a great gap over decades between rising worker productivity and real wages, and we're hoping to close that gap. Would you agree that it would be good for a more inclusive economy if worker wages tracked worker productivity increases?
I think if you include benefits, that's a significant part of that gap. I've looked into that, but not for some years. But I mean, generally speaking, people's compensation should be over time equal to increases in productivity.
I appreciate that, and I also want to. There's the trade-off on workers' wages, and there's also an issue with price gouging, right? So we have seen record profits. We've also seen very high prices these corporations are charging for things like groceries. Now, I listened to a little bit of exchange with the chairman earlier, and of course, I think your answer was, people will charge what consumers will pay. But it should be known that these corporations are reaping much larger profits now than they were pre-COVID, for example, right?
I mean, some of them are. I'm not super focused on individual corporate profits, but yeah, corporate profits, I gather, have been high overall.
Right. I mean, they're high for a couple reasons. One is that they're charging consumers, for example, at the grocery stores, a lot of money. And the other would be if they're not sharing the benefits of labor productivity with their employees. So I think because we've heard a lot of claims by some of our Republican colleagues about the causes of price increases, and I think it's very important that American consumers recognize that corporations are choosing to charge them more at the grocery store or engaging in things like shrinkflation rather than in order to have more of their profits. Let me turn briefly to a letter that I sent to the Vice Chair of Supervision and some of the other federal regulators in January of this year regarding the Basel III capital requirements, and I support the overall effort on Basel. We did raise concerns with respect to a specific issue, which is the harmful and we think unnecessarily harmful impact it could have on clean energy tax credit investments. And all of the regulators testifying that day, including the vice chairman, said they recognized this was a significant issue and hope to address it. Would you agree with that?
Yes, I would.
Thank you. Thank you, Mr. Chairman. Thank you, Senator Fetterman.
Thanks, Chairman Howland. Senator Fetterman of Pennsylvania is recognized.
Yes, I love that. All right. So it's great to be here with you today. Now, I don't know, maybe some people in America were talking about a cookie that was $18. And I was alarmed, and I hope we investigate that there is a cookie that costs $18. And do you believe that an anecdote on Twitter about a cookie that cost $18, is that reflective of our economy and where we're at or not?
I certainly hope not. I don't do much shopping these days, but that sounds like a pretty expensive cookie.
Yeah, and now, I believe that that the American economy now is the envy of the world after everything right now. Correct?
We are. Yes, we're performing very well compared to our peer group.
Yeah, pretty great. And is it fair to say that the stock markets are all up at record highs? Right?
Pretty close.
Yeah. And inflation has been pretty effectively addressed, right?
It's been coming down sharply since the middle of last year. Yes, we've got a ways to go on that, but we've made a lot of progress.
And corporate profits are pretty robust. Is that fair?
I believe it is.
Okay. Well, we can agree that, and I don't understand why more people seem to be talking about a cookie that cost $18, but that seems to be against the evidence as well. But given that, now, since things are pretty great, and we're in a really great, excuse me one second, place, but now I am concerned, and there's rumors going around that Basel, they're going to change, and they're going to reducing the capital, and I guess I'm concerned about that because I don't know why we would want to, and also I want the record to reflect on you're much smarter than I am. But I would be concerned that things are in a really great place right now. We can all agree on that. I would be concerned to change something like that because I wouldn't want to have something, again, like what happened with SVB. And I just wanted to get your take on that.
Sure. So U.S. banks are well capitalized, and generally speaking, they're quite well capitalized. And we're not talking about reducing current capital levels at all. Really, in the Basel III endgame, capital may well go up. And what we're talking about is whether the proposal that was put out by the bank regulatory agencies, including the Fed, and which has now been the subject of quite a lot of comment, whether, what changes will be appropriate to that. That's what we're talking about. We're not talking about reducing existing capital requirements.
Oh, okay. Well, and then I also want to play off of a comment made by my colleague from Tennessee, and I actually agreed with him. And he's concerned about the deficit, about it's $1 trillion for every $100 days. So now, if the federal government had added $3.5 trillion to the deficit by extending the Trump tax cuts, would that increase or decrease inflation?
So I'm going to fall back on our long-time reluctance to comment on fiscal policy. We take your fiscal policy decisions, whatever they may be, we take them as they are, and we conduct monetary policy to achieve 2% inflation. But we don't score inflation. CBO does that. They'll make a judgment on that, but it's not something we do because we're an independent agency, and that requires us to stay the heck out of politics.
So I don't want to put you on the spot, but would those kind of tax cuts would that help addressing inflation or inflame inflation?
I don't know what the effects would be on inflation. I do know, broadly speaking, we need to get to a place where revenues and spending are better aligned, and I think everybody knows that. And I think we used to talk about this a lot 10 years ago. We're not talking about it so much anymore. That's understandable. The pandemic was a special thing, but I do think it would be great to get back to that on a bipartisan basis.
Okay. Well, I have about 30 seconds left. I just want to go on the record. I think you've done a really great job. And I think our economy, and I do agree that it is the envy of the world as well. And I'm confused that more people are talking about cookies or McDonald's meals and those kinds of a thing. It's not reflective on the strength of this as well, too. And I just want to thank you for your service.
Thank you, sir.
Mr. Chairman.
Thank you, Senator Fetterman. That's the last question. And thanks for your generosity in yielding to colleagues who got here before, whom you got here before, if I said that right. Thank you, Chair Powell, for joining us today. And every 6 months and sometimes more often, I look forward to working with you, continuing to work with you to strengthen our economy. Senators who wish to submit questions for the hearing record are due 1 week from today, March 14th. To Chair Powell, please submit responses to those questions for the record no more than 45 days from the day you receive them. Thank you again for your testimony.
Thank you, Mr. Chairman.